Today, warnings that shook the markets. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and prop news with a distinctively Australian flavour. Well, the S&P 500 and the Nasdaq finished in the red on Tuesday. Worries that aggressive moves to curb decade-high inflation might tip the US economy into recession dampened investors' risk appetite. So all three major US stock indices paired their losses in the afternoon, with the blue chip Dow just turning positive at the end. But even so, the S&P 500 ended just 2.2 percentage points above that 20% bear market benchmark. The Dow Jones Industrial Average rose 0.15% to 31,928. The S&P 500 lost 0.81% to 3,941, but the Nasdaq dropped 2.35% to 11,264. And by the way, the volatility index rose 3.41% to 2945. Across the indices, 6 of the major sectors of the S&P 500 ended the session in negative territory, with the communications services sector and consumer discretionary sectors suffering the biggest percentage losses. As we step back and acknowledge the primary market catalysts, it's really been about the Fed pivot and the change in interest rates, which have influenced prices across the capital markets, said Ben Northey, Senior Investment Director at US Bank Wealth Management. In the last 2 weeks, we've seen some degree of macroeconomic deterioration starting to be manifest in corporate earnings and economic releases. Much of the sell-off was driven by a profit warning from Snap, which sent the company's share prices falling 43.1% and sparking contagion throughout the social media segment. The warning from Snap will sound the alarms on the deteriorating macro's evolving effects on digital advertising, RBC said in a note, after slashing its price target on the stock to $17 from $25. And elsewhere on the earnings front, companies continue to flag the impact of inflation and worries about the growth outlook. Concerns about a weaker backdrop of advertising spending sent shockwaves through social media stocks, with Meta platforms down more than 7%, Twitter was down more than 5%, and Pinterest slumped more than 23%. Zoom Video Communications, meanwhile, sidestepped the selling after the software company reported better than expected quarterly results and raised its annual guidance, sending its shares up more than 5%. The broader S&P 500 communications services sector slid 3.7%. And in retail, Abercrombie & Fitch tumbled 28.6% after posting a surprise quarterly loss and cutting its annual sales and margin outlook. The surprise first quarter loss was linked to rising transportation and product costs. AutoZone, though, rose more than 5% following better than expected quarterly results, and Toll Brothers, which reports quarterly results after the market closed, fell more than 4%. Lennar and KB Home were also in the red. Global supply chain disruptions have been exacerbated by Russia's war with Ukraine and restrictive measures in China to control the latest COVID-19 outbreak, sending inflation to multi-decade highs. And of course, the US Federal Reserve has vowed to aggressively tackle persistent price growth by hiking the cost of borrowing. And minutes from its most recent monetary policy meeting, coming out on Wednesday, will be parsed by market participants for clues regarding the speed and extent of those actions. Investors currently expect a series of 50 basis point rate hikes over the next several months, fueling fears that the central bank could push the economy into recession, a scenario which is increasingly being baked into analyst projections. Tomorrow, we look to the FOMC meetings for any signs that the approach to monetary policy may lean further hawkish or dovish than was laid out at the last meeting. Data released on Tuesday painted a picture of waning economic momentum, with new home sales plunging and business activity deaccelerating thanks to rising mortgage rates. New home sales fell by 16.6% in April from March and were down 26.9% from a year ago, according to a joint report from the US Department of Housing and Urban Development and the US Census Bureau. That was the fourth consecutive month of declines, with sales falling to the lowest level since the early days of the pandemic in April 2020. Only 591,000 homes were sold last month. That was down from a revised 709,000 in March. Buyers saw their budgets stretched thin by long construction times, mounting costs, and rising mortgage rates. The average interest rate for a 30-year fixed-rate mortgage went above 5% in mid-April, and it's now up 2 percentage points since January. High construction costs and surging mortgage rates are keeping many buyers away this spring, said George Ratiu, senior economist and manager of economic research at Realtor.com. New construction has been appealing to many would-be buyers who have accounted the lack of existing homes to choose from over the past 2 years, but the rising costs of a new home is now pricing people out of the market, he said. The median price of a new construction home was $450,600 in April. That's 20% higher than a year ago, when the median price was $376,600. Given the increases in both prices and rates, the monthly payment of principal and interest for a median-priced home is 57% more expensive today than a year ago, costing a homeowner $720 more a month, according to numbers from Freddie Mac. The movement in the new home market is mirroring broader real estate trends, in which rising inflation is taking a bigger bite out of Americans' paychecks, and surging borrowing costs are reducing home buyers' purchasing power. That's pushed a lot of first-time buyers to the sidelines. With affordability on a steep decline, new homes have become a luxury for trade-up buyers with significant equity or investors with cash looking to turn them into single-family rental developments, said Ratiu. Newly built homes in lower price points remain a small part of the market, and sales of entry-level new homes, those priced below $300,000, accounted for less than 20% of April's total new home sales. And while labour costs remain elevated, prices for materials are showing some signs of moderation that could bring some relief to high construction costs, said Ratiu, who noted that the price of lumber had been declining. Home builder sentiment, which measures builder perceptions of current sales conditions, the traffic of prospective buyers, and sales expectations for the next 6 months for single-family homes, fell in May, according to the National Association of Home Builders and Wells Fargo, through their Housing Market Index, which was released last week. It was the 5th straight month that builder sentiment declined and was the lowest reading since June 2020. Robert Diaz, NAHB's chief economist, said that the cost of building materials is up 19% from a year ago, and that less than 50% of new and existing home sales are affordable for a typical family. Entry-level and first-time home buyers are especially bearing the brunt of this rapid rise in mortgage rates, he said. It's worth, of course, underscoring the difference in price of US homes compared with Australian homes, but the same trends are now being seen in both markets. Fed Chair Jerome Powell's counterpart in Frankfurt, European Central Bank President Christine Lagarde, said that she expects the ECB deposit rate to be raised to at least 50 basis points by the end of September, in a significant change of trajectory. And the Federal Reserve is pumping the brakes. The most interest rate sensitive sectors, notably housing, are cooling, Grant Thornton said in the note. And the melt-up in the dollar has come unstuck recently as the odds of the Federal Reserve putting its rate hike mission on ice later this year gathers pace. The US dollar index, which measures the greenback against a trade-weighted basket of 6 major currencies, fell 0.3% to 101.81. While stability in the US rate markets could start to see volatility levels temporarily edge a little lower, ING was quick to warn that a prolonged U-turn or correction in the greenback was unlikely, We favour stability over a sharp correction lower for the broad dollar trend, largely since the Fed has the largest cause of any to be tightening rates sharply, ING said, noting that the Fed rate hike expectations could change following the central bank's June meeting. When it comes to the US, the idea of a Fed pause in the summer is gaining a little traction, ING said in the note. Fed members, including Chairman Jerome Powell, recently led out the red carpet for two 50 basis point rate hikes at the next two meetings that could provide the central bank with breathing room to reassess the threat of inflation becoming entrenched. Atlanta Fed President Raphael Bostic was the latest Fed member to back the idea of a Fed pause later this year. I have a baseline view where, for me, I think a pause in September might make sense, Bostic told reporters on Monday following a speech at the Rotary Club of Atlanta. The remarks arrived on the heels of the Kansas Fed President Esther George, a former arch hawk, who also on Monday seemed to support the view that the Fed should reassess the situation after 50 basis point hikes in both June and July, ING said in its note. The cooling expectations for aggressive Fed rate hikes have hurt two-year Treasury yields, which are sensitive to Fed rate hikes, forcing the dollar to put the brakes on its advance. So the two-year ended up 1.25% to 2.5141, but that's compared to a recent high of 2.84%, and the 10-year was down 0.14% to 2.756, compared with a recent high of 3.2%. So this does now pose the question, will we see rates go up and then come back down again later in the year? But then again, this could all change at the next FOMC meeting on the 15th of June if the dot plots were to show 3+% rates for the end of 2023. But then that meeting is another 3 weeks away. And elsewhere, the US will close the last avenue for Russia to pay its billions in debt back to international investors on Wednesday, making a Russian default of its debt for the first time since the Bolshevik Revolution all but inevitable. The Treasury Department said in a notification that it does not plan to renew the license to allow Russia to keep paying its debt holders through American banks. Since the first round of sanctions, the Treasury Department has given banks a license to process any bond payments from Russia, but that window expires at midnight on May the 25th. There had already been signs that the Biden administration was unwilling to extend the deadline. At a press conference heading into the Group of 7 finance ministers meeting in Germany last week, US Treasury Secretary Janet Yellen said the window existed to allow a period of time for an orderly transition to take place and for investors to be able to sell securities. The expectation was that it was time limited, Yellen said. The US ruble cross rate was last at 56.8, having reached a high of 152 in early May. And again, elsewhere, significant issues remain in reaching a deal with China over a long-running dispute around auditing compliance of China-based companies listed on US stock exchanges, according to a US Securities and Exchange Commission comment on Tuesday. The SEC's International Affairs Chief, Y.J. Fisher, told an audience that the agency's accounting body, the US Public Company Accounting Oversight Board, the PCAOB, would need to complete China audit inspections by November the 22nd to meet a US deadline that will require non-compliant Chinese companies to delist by early 2023. Fisher added that Chinese authorities should consider delisting from US exchanges a subset of issuers that it deems too sensitive to comply with US rules. While there has certainly been progress in the discussions on audit inspections in China and Hong Kong, significant issues remain, said Fisher. Even if an agreement is signed between the PCAOB and Chinese authorities, it will only be a first step, she said, since the United States would then need to commence on-the-ground inspections. In December, the SEC mandated that Chinese companies listed on US stock exchanges must disclose whether they are owned or controlled by a government entity and provide evidence of their auditing inspections. Under the rule, which implements a law passed by Congress in 2020, more than 200 companies, including Alibaba, Baidu and Weibo could be kicked off US exchanges if they're not compliant by the end of 2023. Spot the common thread. They have all fallen in value in recent months. And unlike many countries, China has not allowed the accounting regulators to inspect Chinese company auditors due in part to national security concerns. And US regulators worry the lack of US oversight is putting investors at risk. Several media outlets had previously reported that there had been progress on the talks, and while Fisher confirmed that, they warned time was nevertheless running out to reach a workable deal before next year. And over in crypto land, Bitcoin remains below 30,000 US. It was last at 29,592 and Ether was at 1,975. The biggest loser on the day was Solana, which traded down 9.3% to $48. Bitcoin has lost half its value since the November 10 peak of 69,000 US, and this week it's flirting around the 30,000 mark after touching a 17-month low of 25,401 on May the 12th. Of course, it remains the largest digital asset by market capitalization, but the market valuable cryptocurrencies now stands at $1.3 trillion. That's less than half the $3 trillion peak back in November. Data platform CoinGlass's Bitcoin Fear and Greed Index of Market Sentiment, where 0 indicates extreme fear and 100 extreme greed, is hovering at 13. And Ether, the number 2 token by market value, has hovered near the $2,000 mark and was down around 60% from a peak of 4,868 on November the 10th. Baal Havez, CEO of research firm Macro Hive, pointed to 2,300 and 2,500 as key levels and warned that failure to hold above either of those in the near term would mark a bearish signal. Total spot market volumes for all cryptocurrencies at major exchanges have fallen to $18.4 billion as at Monday. That's less than half the $48.2 billion seen on May the 14th, which was the highest volume for 2022, according to news and research site The Block. And blockchain analytics firm Glassnode said on May the 9th that Bitcoin at 33,600 put 40% of investors underwater on their holdings. Many folks are left wondering what they should do with their coins. Keep holding on for dear life or book losses and move on, said Lindsay Bell, Chief Market and Money Strategist at Ally Invest. It's a good reminder that crypto probably shouldn't be more than, say, 1 or 2% of your portfolio. And the crypto winter is into its 9th week, and Bitcoin can't shake the chills. From technicals to turnover, market indicators are flashing red or amber for the biggest cryptocurrency, which has lost a third of its value in just 2 months. So where to now? Well, Bitcoin's limited history isn't much of a guide on crypto winters, which we'll define as prolonged bearishness for a month or more. There have actually been 5 since 2017 and 3 since 2021. Last year's 2 crashes lasted 14 and 10 weeks and caused Bitcoin to lose 45% to 47%. If they were typical, Bitcoin's latest drop at 36%, shed in 8 weeks, has road left to run. Bitcoin is just not attractive to retail investors right now. Nobody really sees that potential for Bitcoin to give out 10 times return, said Joseph Edwards, head of financial strategy at fund management firm Solrise Finance. Indeed, the macro background is far from supportive for an asset class now firmly seen as volatile, risky, plus vulnerable to the face of inflation. And as worries over rising global rates and geopolitics brings US stocks close to confirming a bear market, cryptocurrencies aren't on anyone's shopping list. Yet, even in the icy wilderness, there are some signs that the crypto king is plotting its comeback. Bitcoin is drawing strength from the rest of the crypto market. For example, its relative stature providing some comfort for investors fleeing altcoins such as stablecoins deemed ultra-risky after the collapse of Terra USD in early May. Bitcoin's dominance, a measure of the ratio between its market cap to the rest of the cryptocurrency markets, has jumped to a 7-month high of just over 44%, even as its price has decreased. Institutional investors particularly are fleeing to safety, to a certain extent to Bitcoin, which has the most institutional adoption, said Marcus Ciatoru, analyst at UK-based asset broker Global Block. Last week, Bitcoin futures saw their largest net long position since the contract was launched in 2018, according to CFTC data. And it indicates traders are increasingly positioning for a rise in the price of cryptocurrency. Bitcoin price action remains at the mercy of equities, though, and Wall Street, of course, is looking pretty dodgy. Altcoins once more accelerated declines on the day, with several of the top 10 cryptocurrencies by market cap approaching 10% daily losses. So whether you look at crypto or the main markets, you've got to say scary times are here. And really, there is nothing to indicate other than more pain ahead. So keep watching for those signs. Those signs will probably continue to point south. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.